So without further ado, I'd like to introduce Andrew Cowley, who is the managing partner for Impact Healthcare REIT. Andrew's going to take you through about a 30-minute presentation, and then I'll pick up at the end. So welcome, Andrew, and over to you.
Thank you very much, Mike, and thank you to everyone who's made time available this afternoon. I understand how zoomed out many of you are probably feeling at this point. What I'll try and do in the next half hour or so is give you a sense of what our strategic aims are as a business, how we aim to deliver on that strategy and generate returns for our investors by doing that, and why the market we're investing in is supportive and enables us to execute the strategy well, or hopefully well. The presentation I'm going to go through is a lengthy presentation. I'm not going to go through every slide, and if anyone thinks I'm going too fast or would like to go back and look at detail, it's available on our website, on the Impact Healthcare website. If you look at the bottom of the homepage, the presentation is there, and I think ShareSoc will be sharing it with you as well later. So when I co-founded the Impact about just over 4 years ago, we set ourselves a number of key strategic aims. The first is to invest in healthcare-related real estate in the UK. That's our mandate. We can only invest in the UK in real estate which is used to deliver some form of healthcare. So far, we've decided to focus that on elderly care because we think that's where the deepest value is, and also that it's a virtue for us for keeping the business and the way we execute as simple and focused as possible. So today, we own 111 properties in the UK, just over 6,000 beds, 13 tenants. To put that in a bit of perspective, the total market size for residential elderly care in the UK is about 465,000 beds. So we own 1.3% of a very fragmented market. I'll come back to that. So our first and most important aim was to make sure we were building a business which would be sustainable and resilient over the medium and longer term. Always think about the longer term. And we would like to think that we can now say that it's not theoretical. We've proven the business is highly resilient in a very difficult time. We all agree the last 18 months have been an extremely difficult, challenging time for everyone and everything in the country. Through that, we have collected 100% of the rent due to us in full with no lease variations. And as far as I'm aware, there are only 2 REITs listed in the UK market that can say that at this point, us and Supermarket REIT. Okay, the caveat to many things I'm going to say, the pandemic's not over yet. If there is a new variation which is vaccine resistant, sadly all bets are still off. But so far through the pandemic, our rent collection record has been 100%. Wouldn't be great me sitting here saying that. Isn't it wonderful? I've collected all the rent from our care operators who are doing a critical job during a pandemic, and we're putting extreme pressure on them as a result. Our tenants have also been highly resilient, measured by their rent cover. I'll come back and go through that in a bit more detail in a few slides' time and explain what I mean by that. So as long as our rent collection record is intact, our tenants are resilient, that's what underpins our key strategic aim, which is to deliver to our shareholders over time a sustainable and progressively increasing stream of dividends. So when we started out, our dividend target for the first 18 months was 6p a share. We delivered that on a covered basis. And then from the beginning of 2019, we introduced a progressive dividend policy to grow our dividends roughly in line with inflation. 100% of our leases are inflation linked. So our dividend target for this year is 6.41p a share. We declared the third dividend for Q3 last week. So we're well on target, and the dividends we are paying are fully covered. Next objective was to make sure that at all times we're running a very strong conservative balance sheet. So we spent the first 12 months of our corporate life with no debt. Our maximum LTV is 35%. Our drawn down debt at 30th of June, our mid-year financially, was 14%, 14%. We've always put an emphasis on having a very strong balance sheet. And then the final tool we have, and a way of delivering some capital growth to our shareholders over time. So it's not just about income, we're also targeting to deliver some capital growth, is active asset management, physically changing buildings we bought in a way that improves them for the residents, our tenant, and creates value for our shareholders. And before I turn over to Q&A, I'll give you a couple of examples of what we mean by active asset management. Amanda, can we go to the next slide, please? So these are the highlights of our financial results for 6 months to 30th of June. For those of you who are more interested in detail, you'll find the results are published on our website, and there is more detail later on in this presentation, which I won't have time to go through today. But you'll see here that our dividends up 2% on the same period previous year, 128% covered by our EPRA earnings per share. Our profits up roughly 30%, and NAV growth of roughly 3% over the same period last year. So we'd like to think and hope you'll agree, a very solid set of results. Maybe we can go on to slide 6, Amanda. Thank you. So we have got a very strong set of lease structures in place. We have 111 leases on individual buildings, and with each tenant, we have a master lease, a framework agreement. As I mentioned, all our leases are inflation linked, so they're fixed rents which increase annually at inflation, with floors and caps in case inflation does something very surprising, or maybe at the moment not too surprising actually. They're very long-term leases, so our WALT is just under 20 years. We're typically putting new leases in place at between 25 and 30 years, no break clauses, so strong lease packages. There's only any point in putting those kind of lease packages in place if the market you're investing in supports them. So why do we think our market is supportive of such strong lease structures? So the first is the most basic in any market, supply and demand. The core demographic for people who need care in a residential care home are people in their late 80s and the last 2 years of life. The over 85s are the fastest growing part of the UK population. They're like that part of the population is like to double in numbers of people over the next 20, 25 years. The capacity has not been rising in line with potential demand. So for the past 10, 15 years, supply of beds for people, for elderly people, has been stagnant. So supply and demand make this market interesting. Next slide, please. As I mentioned earlier, but another facet of our market, which makes I think it slightly unusual compared to other forms of real estate, is how fragmented it is. So the chart bottom left here is showing that over the last 10, 15 years, the market share of the 10 largest care providers in the UK, elderly care providers this is, has shrunk. So normally in a fragmented market, you expect to see the big corporates using their brand, using their balance sheet to expand, take market share. In fact, the opposite's been happening here. And at the same time, sole traders with 1, 2 homes sometimes do a very good job. They've also been literally retiring from the market. Typically, they set up their business in the 70s, 80s. They're now in their 70s, they're retiring. And so what you're seeing here is growth in the middle market, care providers who run anything between 3 and 80 homes. And that's where our target tenant base is, in that growing, successful middle market operators. A question we very often get asked is what makes you think it's safe with these very long-term leases for your rent to go up each year in line with inflation? Isn't that at some point going to put a lot of stress on your tenants? So the chart on the bottom right here on slide 7 is the longest data series we can find. And it shows what care providers' fees have been doing over the past 22 years. So on average, fees for residential care have gone up at 3.7% per annum, and for nursing care, 3.8% per annum. And there have only been 2 or 3 years in that period in which those fee increases have been below RPI. So our potential universe of operators, of tenants, has demonstrated they can drive their top lines at inflation plus over a long time period. Can we go to the next slide, please? So I managed to get this far without mentioning the C word, COVID. So obviously, what our tenants have been at the front line of the pandemic. We knew from early on, March last year, we didn't know much about this virus, but the one thing that was clear from very early stages was the elderly, particularly ill elderly people were by far the most vulnerable to it. So very sadly, the death rate in care homes in wave 1, April, May 2020, was 3 times higher than the 5-year average. So that was the big problem last year. As the pandemic's progressed, we saw an increase in deaths in January, but much lower than in April, May last year. And since week 8 this year, most weeks deaths in care homes have been below average, below the 5-year average. I'm going to come back to this a bit later when we look at our tenants' occupancy and how that's been impacted by the pandemic. Next slide, please. Many of you, sorry, this is a very, very busy slide with a lot of words on it, but many of you would have seen that the government announced a series of strategic reforms for elderly care last month. Maybe we might want to get into this a bit more in Q&A. At a high level, I'd say, first, the government deserves a huge amount of credit for trying to address this issue. And I think we all understand the way elderly care is financed and provided in this country does need reform. The previous 4 prime ministers over the past 20 years have said they're going to do something and then found it all too difficult and maybe found some sticking plasters. So this government's had a go. And our view at the moment is they've had a good go at answering 2 of the 3 key questions. So question 1 is the political question, or a question that seems to concern politicians the most. Why is it fair that I should have to sell my house to pay for Alzheimer's care when I get cancer treatment for free? So they've imposed a cap on care costs of £86,000. You can discuss, is that cap the right level? Is it the right approach? But at least they've had a go at addressing that question. The second one is the system needs more funding. How much and how's it going to be paid for? So not all of us will like the 1.25% increase on dividend tax, the increase in national insurance, which theoretically together will raise £36 billion over the next 3 years, roughly 12 billion a year. We understand that obviously the NHS is going to absorb most of that money in the short term to clear its backlog. But relative to the size of the elderly care market, so the total cost of people living in care homes is £17 billion a year, of which roughly 45% is paid privately, 55% paid by government. Relative to this market, the numbers we're talking about here of the increase in taxes, more funding potentially available, are very large. The third question is the one that interests me the most, is if, let's hope when rather than if, but I think we still have to say if this additional funding does flow through, how will it be spent? Will local authorities be able to pay more for the care they're procuring? Will that in turn enable care providers to pay better wages to their staff? So we've got a more expensive but better quality care system. I think something we should all hope for, actually. Paragraph 51 of what they announced said, detail will follow. We will publish a white paper on these issues between now and Christmas. So let's see if they do follow through. But it's very easy to carp and criticize from the sidelines, but I think if they do follow through, these reforms are potentially transformatory in a positive way, but you always have to be careful what you wish for. So we go to the next slide. What we've been seeing in our market is quite a lot of people actually have noticed that the market's been much more resilient than expected. The yields on what we do are attractive to what other real estates look like, and that's attracting more investors. This was happening pre the government's announcements. So the Octopus, large private capital vehicle, have raised a lot of money to buy care homes. Our closest listed comp Target raised more money last month, and we're seeing a number of European operators, both real estate investors and care providers, come into the UK market. Interestingly, none of them came in before Brexit. They're all coming now. Let's not get into that one. So I don't want to make predictions about the future. I'm not clever enough to do that, but it feels to me like if yields move in our market, they're more likely to compress than widen out. That could be good, very good for the value of our existing portfolio, but it could make it more challenging for us to go on buying assets on the terms we're used to. And I'm going to give you some examples of that in a couple of slides' time. So if we could go to slide 12, please. So here's a snapshot of what our current portfolio looks like. We often get asked, do you like public pay or private pay? Do you like north or south? And our reply to that is if you want to build a fully diversified portfolio, there are elderly people living in the whole country. They all need access to good quality care. There are very few, there are some, I'd rather not name names, very few no-go areas. But I think looking at this map, you can see, the place I think we're most underweight at the moment, want to do more in, is the Midlands. Because one of the things we're looking for here is good quality assets in what we'd really like, good quality assets in a market town, where on the left-hand side of the A road is housing wealth, people who can pay good fees in the care home. But as importantly of that, on the right-hand side of the A road are people who want to have a job in a care home. It's all very well buying fancy care homes in expensive locations like Ascot. The question you've got to ask yourself is, where are the staff? And there aren't, almost by definition of areas, there aren't any staff in those areas. You need a balance. And again, I'm going to sort of come back to that. We go to the next slide. So this is something I mentioned just now. So what we're trying to show here is we've taken a very consistent, disciplined approach to deploying our shareholders' money. So we're very conscious as we deploy our shareholders' money, we've got to be able to demonstrate what we're doing is accretive. We're not just growing for growth's sake. And also we are diverse through diversification over time, we are reducing risk. So what I was saying about yield tightening just now is a potential. It hasn't happened yet, but I think it's likely to happen. But I'm not trying to send a signal there that we're going to radically move the yields on which we're buying assets. You'll see a number of RNSs coming out between now and Christmas of things which are now in advanced legals. And they will be very consistent with what you're looking at on this slide. If we could go on, please, to next slide. So coming back to the pandemic and how it's affected our tenants. So the big impact on our tenants was in the first wave, and it hit their occupancy. So the average occupancy in our portfolio in March 2020 was just under 90%. I'll pause here and point out that we are not directly exposed to occupancy. So our tenants pay a fixed rent for renting the building from us, and it goes up each year in line with inflation. It's up to our tenants how many of the beds in that building are filled and in use. But clearly we are indirectly exposed. If occupancy goes down and stays down, the rent they owe us will be at risk. It went from 90% to 80% in the wave one. It recovered a bit in summer last year, and then dipped down again in the second wave to hit what we hope was the low point of 79% in January. It flatlined in February and March, and since April, we've seen a steady return to normality. Occupancy going up 0.1, 0.2% a week. So it's clearly now heading back in the right direction. I'm not sure it's going to be a linear, straightforward journey back up to normal 90%, 90% plus. The winters there's often some seasonality in winter. Maybe there'll be a flu outbreak this winter, but it's clearly heading in the right direction. And what we've done on the bar charts on the bottom right here is try to get under the skin of this a bit more into the detail. Work out how sustainable is this occupancy increase. So occupancy in a care home has three drivers. So new admissions, people coming in, leavers, people leaving. Sometimes people leave because they don't like the care home. That's quite rare. Sometimes they leave because their care needs have changed. They've become more acute and they need a care home that can cope with more acute needs. And most commonly, though, it's respite care. It's people coming in for 2-3 weeks, maybe coming back again. So the key number there is net admissions minus leavers. And you'll see for our anchor tenants, the tenants we have from day one, where we've got very good granular data going back 6 years, but that was 3.2% a month. And then deaths were averaging 3% a month. So their occupancy was gradually going up. Sadly, in the year ending March 21, admissions below average, leavers below average, deaths above average. So as occupancy goes down. In Q2 this year, admissions and leavers had returned to normal levels and deaths were below normal. We've just got the Q2 data and we're just crunching through it. So we'll have a better feel for how it's moved since Q3 data, how it's changed since Q2. What we're not seeing yet is admissions running above average. Anecdotally, we're told there's a lot of pent-up demand out there. People who maybe should have moved in the care home a year, 18 months ago and have chosen not to do so, or their families have chosen not to do so. I think what's holding admissions back still, or holding that pent-up demand back, is fear of new lockdowns. I think if you were a family thinking about how to provide the best care for your mother or father, and you thought lockdowns might come back, and I won't be able to see them for the next 6 to 9 months, you're going to do whatever you can to keep your relative at home for longer. And also, if you've been working at home, there are more options open. So we're not seeing admissions running above average, proving there is pent-up demand, but we're watching that one carefully. So occupancy at the moment, so occupancy today, that 83% number is early September when we published our interims, and now it's 84.5%. So it's got another 5.5% or so to go before it's back to normal levels. But maybe next slide, please. So, but despite the occupancy hit, our rent cover across our portfolio has continued to be very solid. So what do I mean by rent cover? The way we report on rent cover is we look at home level profitability, our tenants' profit from pre-tax profit and pre-rent profit from operating that home, divided by the amount of rent they owe us. So immediately pre the pandemic, our portfolio rent cover in Q1 2020 was 1.7 times. In Q2 this year, it was 1.9 times. So it's gone up during the pandemic. Yeah, how can that be the case when occupancy's gone down? The simplistic answer to that, there's obviously quite a few moving parts here, are average weekly fees. So the average weekly fees our tenants charge for the care they provide are up 8% over the previous 4 quarters. So they've been seeing very strong fee growth, which has largely offset the occupancy decline. We're certainly not predicting that fee growth will continue to be 8% per annum, indefinitely in the future, but we're pretty confident at the moment that the fee growth will continue at the historic levels we mentioned earlier, maybe plus a bit. So before I hand over the Q&A, there's two more main points I'd like to cover. Next slide, please. So the first is just sharing with you some of our thinking about how we go about acquiring assets, and above all, how we go about adding a new tenant to our roster of tenants. I think the single most important thing we, the manager, do for our shareholders is tenant selection. And we put the pause on all acquisitions for 6 months last year, because one of the key things we like to do when discussing, taking on board a potential new tenant is use shoe leather. Spend as much time and rubber, and let's spend time on the road, driving around, visiting the tenants' homes with them, walking around the homes, getting a feel for, in reality, how the tenant operates these homes. Do they know what they're doing? Are they doing a good job? And when problems do arise, it's a people business, care. Problems will always arise. Has the tenant got the right systems, the right people, the right approach to spotting the problem early, getting it fixed, and trying to make sure it doesn't reoccur? And so I'm not going to read out all the words in this slide. It's a busy slide, but the point I'm trying to make here is when assessing if it's a good tenant, do we want to add them to the rent roll? And you've got to look at it in the round. You've got to think, is this a good tenant and a good care home or group of care homes from the point of view of all the main stakeholders? I've listed 3 here: residents, tenants, and us, the landlord. But there are other very important stakeholders like the regulator, local authorities, the commissioners. You've got to stand back and look at this in the round and make sure you understand how the tenant really operates. Having said, okay, fine, I think this tenant makes sense. They're a good tenant, we want to add them, and we want them to run the following homes for us. Next slide, please. These are the more detailed questions we ask ourselves. But I think that, having said the most important thing we do is tenant selection, the second most important thing is making sure we've got the level of rent they're going to pay us right to make sure it's sustainable over the life of the leases. If you kick off over rented, you're just going to end up digging the hole deeper, and there's going to be a problem down the line. So we like buying standing assets. They come with historic performance. We can get into the detail there. We can form a view about how sustainable what level of performance is. When we run sensitivities, we're not just looking at the bad news. We're not a bank just saying let's take 20% off everything. So we do say what can go wrong, but also what could go right, what could be improved. How could these homes with a new tenant, with some capex, how could these homes be improved and perform better? Having worked that out, what's the right level of initial rent? The next question is, what's the lowest possible price we can pay for that much rent? And only then we know what the yield is. The yield comes last, not first. So the question isn't, hey, what can we buy for 7% yield? It's answer all these questions, and then we know what the yield is. And we will only pay for actual performance. We will pay for reality today. We won't pay for jam tomorrow. But if someone says, look, I can really improve the performance of these homes, and there's all sorts of levers I can pull to do that, we say, great, do that. And we'll incentivize you to do it. We're very happy to have a deferred payment to you, which will rentalize, but it's got to be based on actual performance, not promises of future performance. I'm running low on time, so maybe in QA I might want to come back to numbers on the right. So but what we're trying to show there is another way of thinking about what the right level of rent is. What percentage of revenues, of the tenant revenues, are they paying you in rent? So this is a real example from a tenant we have in the northeast of England, primarily operating in the local authority market, making good money while doing that. They pay us 12% based on their actual numbers for 2020. They paid us 12% of their revenues in rent. Typically across our portfolio, it's between 11 and 15%. And I think we know for sure, if you see, when we see business plans for care where the rent, say you're going to buy this home, it's fantastic, and you're going to pay us 15, 20 million, and the rent is going to be 20% of tenant revenues, we know for sure that's just not sustainable. ESG, next slide. What we're trying to make sure we do here is that firstly, it's embedded in everything we do. And secondly, we're taking a practical approach. We're not going to do any greenwashing. So whatever we do, we've got to make sure, do we have a plan? It might be lots of micro projects that's going to actually make a practical difference. So the example we're putting here is we went through all our EPC certificates last year and said the homes which aren't already A and B, do we understand what needs to be done to these homes to get them up to A or B? Not just in theory, but we have a plan for each home. A lot of it's to do with LED lighting, installation, and windows. Do we have a plan? Do we know what's going to cost? Have we agreed with tenant who's going to get it done? Us or them? And the other question we're asking ourselves, maybe we go to the next slide, because it's an example here of asset management in action. So I'll be frank, the driver here wasn't EPCs. This is but it will be a benefit of the work we're doing to this home. So Fairview are 2 units on the A4, about 3 miles east of Bristol city centre. We bought them in 2018. The 9-year-old nursing home on the left is EPC is B, and the Bristol Merchants House on the right is EPC C. We bought the 2 units with planning permission to link them. Unfortunately, we worked out the design was terrible. So we redesigned it and had to reapply for planning. So it's taken us 3 years to get to the start line on this, but we did break ground this summer. So we're going to put £3 million of the REIT's money into building that link building. And coming back to EPCs briefly, we're going to put another £250,000 into environmental improvements across the whole unified building. And the whole thing will be a good solid EPC A after we've done that. Our consultant said, well, you could put another 750,000 into the A+. And the way we thought about that, we said, well, we don't think a single resident or staff member will notice the difference. This will create no real, spending that extra money to go from A to A+ will create no noticeable benefits for anyone working or living here. So why spend that? Yeah, that's probably a waste of money. So we went down the 250K route. Asset management, when we do it like this, is a win-win-win, we think. So the residents will get to live in 17 brand new beds in the link building. In the old Bristol Merchants House, we're going to gut the interior and reduce it from 20 beds to 14 very high quality, big, nice bedrooms, very good bathrooms. And we're going to have to make sure, having done that, that we renovate the nursing home, an 8-9-year-old nursing home to the left fully, so it doesn't start feeling shabby in comparison. The staff are better off. They get that we're going to build brand new kitchens, laundries, all the back end in the basement of the link building, which will be modern as opposed to rather pokey places they're having to work at the moment. Our tenant gets a bigger, easier to operate home. We'll be making more money. We get a much better quality asset, and when we do this work, we charge 8% per annum for our money. So we will get a yield on construction costs of around 8.5%. So that's very interesting. So good income over the longer term. And it's also where potential for capital gains come in. So we'd expect the valuer in today's market in a couple of years' time to be using, assuming nothing changed in terms of yields, be using a yield of 5.5, 5.75 on Fairview. So if you take the yield on construction from 8.5 to 5.5, you're all clever investors, you can work out the potential capital gain that will generate. So the challenge for us, I've run out of time now, I promised I'd speak for half an hour. The next size example of a different kind of asset management project we're doing in Norwich, where we're forward funding a new nursing home and building some extra care retirement living bungalows in the ground. So that's a slightly more ambitious project we're doing at the moment. I think you've been very kind and listened to my voice for a bit too long now. So maybe I could hand over to Mike to throw some questions at me.
Right, thank you, Andrew. Yes, and do note, everybody, that you can see the presentation pack yourself afterwards if you want to see the slides that Andrew hasn't managed to cover so far. We already have a few questions coming in, but do keep them coming in, or vote on the ones that you see on your screen already, and we'll crack on and get through them as quickly as we can. The one that's floated to the top so far. How do you see the present labour shortage and consequent likely increase in wage rates affecting your tenants and therefore indirectly IHR? I guess you alluded to the fact that they already any indexation that you may have in your rents can be or seems to be easily covered by the indexation in the prices that they're charging in the market at the moment, which are going up at a reasonable clip. But I guess the labour shortages may be an extra cost burden over and above, say, inflation rates in the short term. So yeah, they won't necessarily be able to recover all of that in their pricing structures.
Great question. Something I didn't mention is when we, I'm sorry, I'm going to sound like I'm not directly answering the question, but a bit of background first. When we sign new leases with our tenants, we attach a spreadsheet to a lease and say, this is the reporting format you're going to give us monthly. So they're committed under the lease to give us detailed management reporting, not just the financial numbers, but their operating data. So we can track staff numbers, staff hours, staff pay, all those things on a monthly basis. During the pandemic, we went to them and said that we don't bother you, but we need to track occupancy weekly. So they've been giving us a weekly flash report on occupancy. And since the beginning of this month, we said to them, can we have staff data fortnightly? We just want to stay on top of what's going on here. We haven't yet seen a step change in this in terms of staff costs. And the reason for that, again, care is slightly unusual. So it's different to a pub or a hotel or a form of hospitality, because the starting point is actually care homes are overstaffed. They've got to be staffed. Staffing is not an option. It's the main thing the regulator looks at. Are you staffed up correctly? Do you have enough people on shift, morning, afternoon, evening to deliver care required? And so if you've got a home operating at 85% occupancy, you've got to be staffed up for 100%. Because typically, so say a 60-bed care home, a well-designed one would probably be subdivided to 4 15-bed units. So the only way you can cut staff would be to shut a 15-bed unit. And if you're 85% occupancy, you can't do that. So you're actually, relative to today's occupancy, if anything, you're slightly overstaffed. So that's why the problem hasn't, so I'm not saying the problem's not going to hit, that's why it hasn't hit yet. The problem's going to be about staff, not hiring more staff retention. So we are expecting that pressure to mount up. And as you implied, Mike, in the way you presented the question, history tells us that wage pressure actually over time can be a care provider's friend. Might sound a bit odd, but one reason fee growth was so strong between 2016 and 2021 was, you remember George Osborne, when he was still Chancellor, said, I'm going to drive minimum wage at 6% per annum. And care providers had to, the average fee wage increase in care were about 4.5. It's only lower pay people got 6, managerial 3 and a bit, average out about 4.5. And when you sit down with a family or the local authority and say, I need to increase the fees you're paying because of this, they get it. They get what the argument they don't get is, I'm going to increase your fees because I've got this much capital tied up in the business and I need to make a return on capital, no one's interested. Wage pressure, people understand, but there is a lag effect. You can only, so something else I didn't mention, in the local authority government market, care fees increase in April in England, April each year. Scotland's a bit more generous with public money as usual, it's twice a year, but April's a big month in the local authority market, private as and when. So if there's substantial wage pressure between now and April next year, operators will feel the pinch, but we're pretty confident they'll be able to recover that in April next year. The most worrying thing I've heard so far in the short term, the biggest national operator, HC1, who is not a tenant of ours, apparently has told a few people this week they're not admitting new residents because they just can't find the staff. But I think that's because their occupancy is below 75%. They've been really badly hit. And I suspect they had closed down subunits, and now they can't restaff them.
Right. So that's probably, in a way, a bigger risk for you is a complete absence of labour rather than more expensive labour, because then, of course, it would impact on occupancy rates and revenue streams for the homeowners.
What we're hearing, so our tenants are watching this very carefully, and we're sort of watching them very carefully at the moment. What we're hearing anecdotally is in the care business, the business which has been really, really badly hit already is domiciliary care at home, being provided in people's houses. It's become very hard to find people to do that.
Right. Okay. Thank you. There's I actually deleted the wrong question just now, so I'll go back to it. I didn't want to lose it. Two questions here. Do you consider building homes from scratch for good tenants? And also, do you intend to raise funds in the near future or on the horizon? And if so, what method of fundraising would you prefer?
So the answer to the first question is, when I talked about active asset management, we do want to make that more ambitious. So we've got 2 new homes coming out of the ground at the moment, one in Hartlepool, which is well advanced, and one in Norwich, which is actually, well, I'm exaggerating, the foundations are going downwards rather than it coming out of the ground, so I exaggerated a bit there. So we have got 2 new homes coming out of the ground, and we want to get more, not less ambitious about that, but we cannot do, in terms of our mandate, any greenfield development. So anything we do will be pre-let, preferably pre-let to an existing tenant who we know and trust, with whom we've got positive cash flow. We've got strong rent cover, because our experience is, my business partner, Mahesh Patel, he's been owning and operating care for the last 35 years. He's lost track of how many homes he's built and opened. He thinks it's over 50. And he says it's always a slower, slightly more painful experience. It should be slower, more painful than you expect, because you need to do it, not rush it. If you build homes too quickly, you'll have a problem. You've got to do it nice and gently. So we want to be a bit more ambitious than that. But with the caveat, we are not a developer. We can't do greenfield development. On funding, you'll understand if I take the Fifth Amendment, talking about any plan. We did so. Plans to raise equity, nothing is agreed with the board. But if you look at slide, there's a slide later in the pack if you have time, where we set out our stall and said we're working on 5 projects at the moment on slide 29. And if those happen, we'll be fully committed based on our currently available capital. The one thing we are thinking in terms of capital funding, just coming back to balance sheet and debt for a moment. So today we've got 141 million of available debt in 4 bank revolvers. We've got an accordion facility with NatWest, will take it up to 165 million. So we've put a premium on our debt so far on flexibility. So draw down debt, acquire assets, refinance the debt with equity. It avoids cash drag, avoids us having a lot of cash doing nothing on the balance sheet. It's an efficient growth tool. And because we're buying things on very attractive yields, we haven't needed the debt structurally to make the dividend cover work. We can make the dividend cover work pretty much ungeared. But we are now exploring putting in place some long-term fixed rate debt. We're talking to a number of non-bank lenders. So I can't guarantee it's going to happen, but in the next 6 months or so, I would hope we'll have 175 million of available debt, of which 50 to 75 would be 10-year fixed rate money lent by an insurance company, and 100 so between 50 75 long-term fixed rate debt, and between 100 125 bank revolvers.
Right.
So that would be the first time we've introduced any permanent gearing.
Okay.
And part of the thinking there is, again, I keep on talking about the future. It's dangerous to predict the future, but it feels to me like if rates are going anywhere, they're going up, not down, and we probably should lock in some long-term money now while we can.
Okay, thank you. Just a question on that slide about the revolving debt facilities you got. I'm not familiar with the exactly how these work in your business. You mentioned there's a security pool against each revolving facility. Propcos 1 and 2, etc. I assume are just pools of assets within your estate. But how does that security pool work with an RCF?
So what we've done so far, we've said to each of these bank lenders, look, your security is what's in Propco 1 and 2 or whatever Propco. So the eagle eye here, you'll notice Propco 5 and 6 aren't in there. We've got 2 Propcos which are unsecured, where we own, So we've got some other assets which aren't secured at the moment. We're saying for them that you've got security over this Propco and nothing else. So there's no cross defaults, and none of those lenders have a PLC guarantee. So if Propco 4 was get into trouble, HSBC only has recourse to Propco 4, has no recourse to Impact REIT PLC. But I think I'll stress here, the likelihood of that trouble happening is very, very remote. So our interest cover across all these Propcos is around 10 times. So at the moment, our rent receipts would have to go down by about 70%, and our value of our portfolio has to go down by 50% before we broke a banking covenant.
All right, thank you.
And we are, as we grow up and develop, our borrowing arrangements will change over time. So when we get bigger, we should be able to borrow unsecured and do fixed rated paper. But I think, you need to be, into market cap standards, you need north of $1 billion, heading towards $2 billion before you can do that. So we just need to make sure that whatever we do now doesn't get in the way of doing that in the future. Whatever we do now, we can unpick and refinance it without paying huge break fees and getting ripped off by the lenders.
Okay, thank you. You mentioned that your leases are inflation linked. There's a question here. Is this 100% against CPI or IPI, or is it in some other way, worked out some other way?
Of the 111 leases we have today, 2 are at CPI. The 2 with the NHS are at CPI, no cap and floor. The other 109 are at RPI, and we've got caps and floors on them. So on 100 leases, the floor is 2% and the cap is 4%. And on 9, it's 1% and 5%. So actually last year, it's hard to remember this now, RPI last year was below 2%. So we got an RPI plus increase. Last time I looked at RPI, it was 3.9, but it may have gone above 4 now. So we have a risk we might get RPI minus something in the next 12, 18 months. But I'm afraid that's exactly why we put these caps and floors in. We were more focused on the cap, if I'm honest, saying, just in case inflation does something really exciting in the short term, we don't want to put unnecessary stress on our tenants. And if they've got a cap, it's fair we have a floor. And so to come back, I'm glad someone's given a chance to clarify this. So when I kept on using the word inflation linked, our dividend policy is not to increase the dividend in line with exactly inflation. What we're saying there is we'll look at the rent increases we actually received the previous year and increase the dividend by that amount. So if RPI is between 2 and 4%, it will be RPI. But if RPI is running at 5%, our dividend increase will be slightly less than 5.
Okay, thanks for the clarification. Can you comment more on your current blend of private and local authority supported residents? Does your business model have a long-term target blend for that?
Our starting point there is, if we're diversified, it should. We've got 2 starting points. If we're fully diversified, it should probably reflect the national market. We've got to be present in both markets. When we assess a new tenant, we are typically looking for someone who's got above average private in their local market. So it's very different. The northeast of England, private pays about 20%. In the southeast, it's 50%. So or southwest, southwest, but we're looking for, it's a good sign of quality. If the operator says, oh, I'm above average in private pay, at the moment, private pay, what we're seeing from our peers and our data has been harder hit by the pandemic than public pay. That's not because more private people have been dying, it's just admissions have been lower. So I hope it's pretty logical. The private pay market, by definition, people have got larger houses, they've got more options, they've got more cash, they can keep mum at home, arrange care at home, they've got more space, they're working from home. To defer decisions to send mum or dad into a care home. That might mean there's more pent-up demand potentially in private pay when lockdowns are definitely over, but we haven't seen any evidence of that yet. The private pay has to be slightly harder hit. And going back to the government reform, something I didn't mention, I mean, there's lots of devil in the detail of what they announced last month. So one thing they said almost in passing is we want to increase public fees and we want to give private pay customers access to public pricing. Now, I've got no idea how think they're going to do that. I don't think they've got any idea either. But potentially, if they follow through on that, there could be, we're not expecting private fees to decrease, but there could be a cap on what private fees do, whereas public fees have got more upside. So at the moment, we've got a slight bias towards the public market rather than private. And the other thing that makes us hesitant about, if you look at the super prime end of the private markets, I'm talking here about very glossy care homes in Surrey, charging £1,500 to £2,000 a week. A lot of money. Yeah. The business plans we see, don't worry about it. We're going to increase fees to 5% per annum forever. And you say, hang on a minute, if you compound £2,000 a week at 5% for 10 years, you're talking a really, really big number. Are you sure about that? And I think the best parallel I can find there is, I think probably many people on this call have had the joy of paying private school fees. And hence we all know how unaffordable they've become for many people because they have been going up at 5% per annum for the last 20 years. And I think in that part of the private market, I think people have slightly lost, some people, not everyone, some people have slightly lost, become adrift from a sense of value for money. It's fine charging £2,000 a week, but you've got to offer perfect service. Really, really perfect service, which means you should have twice as many staff and be paying your staff twice as well, and none of them do that.
Right. Okay. Thank you for that. Who leads on asset management initiatives? Is it usually the tenant, or is it Impact?
So far, it's been mostly the tenant. So it's a tenant coming to us because a care home operates in a micro market. It's basically a 15-minute. You can either define it as 3-5-mile radius or maybe 15-minute drive time. That's typically, obviously, it can be wider if it's rural, but in an urban, suburban setting, it's a really small catchment area. And so the tenant knows that area, and it's up to them to come and say, there's a gap in my market for dementia care, or that's often the driver. There's an undersupply of specialized dementia beds. So a couple of examples, we delivered a 30-bed dementia unit in Leicester and a 46-bed dementia unit in Oxfordshire last year. So the tenant came and said, here's the opportunity. We don't take it at face value. I mean, we do a lot of work. So let's prove this is true and let's work out how you're going to fill these beds. The great thing when the tenant comes to you and says, here's the opportunity, very often you say to the manager, how can you fill these beds? And she, 99% of the time, isn't she, will say, well, here's the list of people who have inquired who I can't help. I haven't got the right kind of kit to help them.
Right.
And that's quite reassuring. I mean, by the time you build it, those people have gone somewhere else, but that's kind of reassuring.
Right.
We are thinking about how to get more front foot on this. And I think if you want to criticize our asset management program, I think it's probably been a bit too opportunistic so far. And we want to sort of get into a position where we can tell our shareholders, it's going to take us a year to do this thing. We can say, here's what our pipeline looks like over the next 3 years. We've got the opportunity to deploy this much capital into this per annum. We control, we won't do more than this, but we can always go a bit slower if we want to. So obviously one caveat at the moment, it's all very well talking about you want to be more active in asset management. Question is today the right time to go out to the market to ask contractors to commit to a fixed price contract? If you do that today, I think you're going to get some very high bids because contractors just don't know what's happening to the prices of inputs.
Okay, thank you. Just as an adjunct to that, I was thinking you've presently got I can't remember, I think you said 111 clients, tenants,
buildings. We got 13 tenants.
Oh, sorry,
111
111 buildings. How many?
Yeah.
How many tenants?
13 tenants. So the NHS
13.
one free. Yeah.
And have you set yourself targets for growing the number of tenants over the next sort of medium term?
Yes, with a couple of caveats. So pre-pandemic, we were adding a new tenant at the rate of roughly 1 a quarter. So it's a slow, steady progress. We want to make sure as we add new tenants, first, we're not diluting overall tenant quality. But two, we want to make sure that we've got a significant relationship with each tenant. So what we don't want to do is end up with 10 new tenants with 2 homes each. Because again, I don't sound, we don't like sole traders who just have 2 homes.
Yeah.
And we don't want to have 2 homes out of 80 from a large tenant where we deal with the junior estates manager. We won't deal with the CEO and the owner of the business. That's our relationship. We want to be significant to them because they're really important to us.
Yep.
But also what we've seen during the pandemic is kind of confirm this strategy. We have got a couple of tenants with 2 homes. And in both cases, they were 2 homes in South of Ipswich, 1 tenant, other tenant, 2 homes south of Glasgow. So the homes were 1.5 miles, 2 miles apart. So geographically the same tenant, same operating standards. During a pandemic, 1 of those homes got hit hard, 1 untouched. But that meant the tenant had a problem, we had a problem. So we want diversification at tenant level. So when we sign on a new tenant, you've got to start somewhere. You might start with 1 or 2 homes. A key question we ask ourselves and with the tenant is it realistic that we could have 5, 8, 9, 10 homes with you in a few years' time? But we'll have a bigger, broader relationship with you. Okay. And if the answer is no, that's it. It's these 2 homes and that's it. We won't necessarily walk away, but we'll start asking a lot more questions.
Okay. All right, thank you for that. Right, we've got 1, 2, 3, 4 more questions, 5 minutes. So hopefully we keep it reasonably swift. We should get through.
Yes or no to one of them.
Yeah. What would you say is IHR's competitive advantage over other REITs, or I guess any other property companies operating in the care home sector, in a nutshell?
It sounds pious, but what we're offering our tenants is a long-term partnership. We're saying to you, we're here to help you, and we want to be, share best practice with you, help you grow and develop your business. We want ambitious tenants who want to grow their business. We're your capital partner, and we won't be the best bid. We've underbid a few times now, and we said, but we're here to help you over the longer term, and talk to our existing. We're very happy for a potential new tenant. We actually recommend them go and talk to our existing tenants and ask them what it's like working with us. It can't just be about money.
Right. Okay, thank you. And how carefully do you police your tenants' maintenance activities? Are there any issues there with increasing costs and scarcity of tradesmen at reasonable prices?
That's really important. Our buildings get operated 24/7. There's a lot of wear and tear.
Yeah.
So in our leases, we have the conventional full repair and insuring language. We've gone a step further. So we put numbers in those clauses. So to help us get comfortable, you're doing enough maintenance. You're going to commit to spend X pounds per bed per annum. At the moment, the new leases are being paid for numbers of typically £1,300 per bed per annum on repair and maintenance. You're going to report that to us in the Excel spreadsheet you're giving. We're going to monitor that, but that's not job done. We're still going to come and inspect. So our team, but also our independent valuer, will come and inspect the home at least once every 18 months. So we've got 4, our eyes and the valuer's eyes on this. It's always we're having a spreadsheet. Are you actually spending the money? Are you spending it on the right stuff? And is it enough? And if it's not enough, we can force you to spend more. But coming back to the long-term partnership point, we put the numbers in, not be onerous and demanding, so that we're trying to avoid arguments with you. So if you could demonstrate you're spending the money, we're still going to check it, but it's one less thing to have an argument about. Right. And we just want to make sure it's like your own house. If you stay on top of this stuff, you don't have problems. If you take a repair maintenance holiday, you're going to have problems.
Yeah. Okay. No, thank you for that. I think you've already touched on this one, really, but I'll just repeat it in case there are any other angles here coming out of this. Will all future fundraising be via banks/insurance companies, or have you looked at bonds or further share raising? I think we've sort of covered all that. You touched on bonds.
We're always going to be conservative balance sheet. So what I said about debt is as far as we're going to go at the moment. To do any more debt, we need more equity first.
Yeah. Okay, thank you. Apart from the capped indexation on your leases, do you have any provision for periodic rent reviews in case we get into, say, a period of hyperinflation?
No. And the reason, and that's not an oversight, it's deliberate. So one question we asked ourselves when we set this up is how to be resilient. And so different asking that question. If you remember 10 years ago, big operators in the UK, Southern Cross, Four Seasons, they went bust. Yeah. We asked ourselves what went wrong. So too much debt, they have 14 times EBITDA leverage. Bad operators, but the other thing, leases too complicated, over-engineered. Their leases had inflation adjustment, over market rent reviews, and profit share ratchets in them. The leases basically said black and white, we're going to make sure you never make any money. Whatever money you make, operator, we're going to suck it out of you.
Right.
So no rent cover, unsustainable amounts of rent, you go bust. So we deliberately said, let's keep our leases as simple and clear as possible. So the operator knows where they stand, and if they get more profit over time, fantastic.
Right. Okay. Thank you very much, Andrew. And that's it. We've covered all the questions. Perfect timing. So many thanks to you for sharing that information with us today. First time you've talked to our members, so we'll be interested to see what kind of feedback we get from the system, and we'll share that with you within the next few days. And maybe we'll see you again this time next year after your next interims, or maybe even after the annuals. So thanks for explaining everything to us today.
Be kind. Don't be too rude. Thank you.
All right. Take care. Bye.